Hello everyone. Welcome to chapter 1 of the Access Cycle. In this chapter, we're going to be discussing the foundational concepts, the concepts that actually makes up the whole system in a detailed and a comprehensive manner. Now, my objective, first of all, with this chapter is that I want to make sure that everyone watching this has a proper understanding of the basics, right? And not just a vague idea, but actually being comfortable with the core stuff and having a complete and a finished understanding of it, because this is what everything else is going to be built on, right? Now, I know some of you might be thinking that, Sham, I already know this part, I already know this stuff, and that's totally fair. I get that. But the reason I'm still going over the core concepts and the basics is not because I think you don't know it, it's because I don't want to leave anything to chance, right? Because the truth is that I'd rather be 100% sure and certain that you've got this stuff down and you have a complete understanding of it, instead of assuming that you do and then it having or it messing up things later for you in your advanced stages. Because trust me, when we actually get into the advanced stuff later in the chapters, if even one of these foundational ideas or one of these foundational concepts isn't right, isn't correct, isn't solid, it's going to throw you off, it's going to throw off the whole system, and nothing will make sense to you, and that will lead you to start misreading things, doubting your setups, or second guess your decisions. And for those particular reasons, I just don't think it's worth leaving it to chance and just assuming that you understand these basics because you've watched other content, and then not introducing you with this stuff right here, right? I just don't think that's worth it. So treat this chapter like a clean reset and understand that whether you are a brand new student or you've been around for a while, we will get through this chapter together, right? We will get through this slowly and steadily. And by the end of it, I'll make sure, I'm pretty certain that I'll make sure that your entire basic understanding or fundamental understanding is rock solid and it's complete. That's going to be my objective with this chapter right here, right? Even if you've watched my other content and watched Romeo's content or ICT's core content and you think that you know the basics or the fundamentals, it's still important for you to go through this chapter, revisit the basics, right? Relearn the basics, and I can assure you that by the end of it, you will leave with extra knowledge, and you will live in a position in a better you will live in a better position than you were before watching this chapter, right? You will have a better understanding of this stuff right here. Okay, now let's move on to the first slide. So looking at this slide right here, you can see the foundational pillars, or you could say the building blocks of the entire access system. What I'm going to do first of all is just list everything out for you. You can see it on this slide right here. And then in the upcoming slides, we will go over each one of these core concepts in detail. I will go over both the theory behind it and how it actually looks in real press action, and I'll also give you some live examples of it as well. These concepts that you can see right here are literally the non-negotiables, right? The whole system, the whole access system becomes redundant or futile or useless or pointless if even one of these core ideas or one of these core concepts is missing. Okay? Without these foundational pillars or without these building blocks, the access system is redundant, it's useless, it will not work. And the reason why I've called them pillars or foundational pillars is because each one of these concepts supports the next one like bricks on a wall. And if you remove just a single brick, the whole thing, the whole system, the whole shit starts to fall. And obviously, no one wants that, right? That's why you've paid. That's why you paid, because you don't want that. And I'm going to make sure that doesn't happen. Okay. And for that particular reason, you need to take every single one of them seriously and make notes and actually consume it in a proper way. Okay. We will start with time frame element and then we will end with SMT, right? I'll discuss both the theory and the practical execution, or you could say the live examples of it. Okay. Now, in the next few slides, what I'm going to do is I'm going to break down each one of these core concepts in a step-by-step manner in the same order, and I'll really make sure that you are clear on not only what they are and how they work, but also how these concepts fit together and makes up the not the success system, the access system. What the fuck? Okay, that's going to be my objective. So let's move on to the next slides. So the first foundational concept that we've got right here is time frame alignment or aligning different time frames with each other. That's basically the essence of it. Now look, there are tons of ways and countless ways people talk about aligning different time frames with each other or giving them structure, right? Everyone's got their own take on it. But what I'm about to show you and what I'm going to show you here and throughout the entire course or the entire curriculum is the specific structure that I'll personally use within the access system, that I personally use within the access system. Now, if you ask me why I've chosen this particular way of aligning different time frames with each other or this particular time frame alignment structure, then there are multiple reasons behind it, right? I could give you multiple reasons for that. But regardless of those reasons and regardless of that rationale, what actually matters is this specific structure has worked for me before, it is working for me now, and it will work for me for the rest of the time and the rest of my trading journey. And not only just me, but it has worked for other profitable, inconsistently profitable traders like ICT, Romeo, and so on. And that's what actually matters here, right? So that's why this is going to be the main focus within the access system. Okay. Now, first of all, before we actually discuss what the structure is, I have to first of all define my model, right? I have to give you the definition of my model. And the most objective and simplistic definition I could find for it is that my model, the objective of my model or the purpose of my model is to trade the range expansion of the daily candle, meaning my model is built around my model is built in a way, or the time frames within it are structured in a way that its main purpose is to exploit the range expansion that occurs within a day or within the daily candle, right? The time frames I use are aligned in a way to make this process right here optimal and effective as possible. And now to do that, I use a 3 time frame structure. In this approach or in this structure or in this way of aligning time frames, I use a combination of 3 different types of time frames, right? Within this 3 time frame structure, I use a combination of 3 different types of time frames, right? Not just 3 time frames, but 3 different types of time frames, and each one having its own objective, its own purpose, and their own different characteristics, right? Each of these 3 different time frames have its own discrepancies between them, right? These are not just 3 time frames, but 3 different types of time frames. Now let me break that down for you. First of all, we've got the higher time frame, and the higher time frame or time frames will be used to establish a directional bias and figure out or determine or identify the drawn liquidity on the higher time frame. Now within this part of the structure right here, you can actually use a combination of time frames, right? You can use multiple time frames within this part right here. to achieve a single objective, which is to establish a directional bias. And the unique thing about this part right here is this is the only part of the three time frame structure where you can use multiple time frames, right? This is the only part where you can use multiple time frames to achieve a single objective, which is to determine a directional bias or to determine a drawn liquidity. And apart from this one, the rest of the two, the contextual time frame and the lower time frame, these two parts are built around just one single time frame for each one. Right now, for this whole phenomena or this whole idea, there are multiple reasons. The best reason I could give you here is that if we use multiple time frames for the contextual part or the lower time frame execution part, if we use multiple time frames here as well, then that will add more variables to the system or more valuable variables to the model. And those variables, those extra variables or factors can lead to more complexity, right? More complication. And then that complexity essentially leads to more inconsistency. And that inconsistency can lead to less mechanicality. And obviously, we want our whole system or our whole model to be mechanical so that we can consistently execute it day in and day out. And because of adding those variables, your model would be less mechanical, and you wouldn't be able to trade it in a way that's effective or that's optimal. Now, we've discussed the higher time frame and its purpose, which is obviously to establish a directional bias. Once you've established that directional bias, the next time frame within this three time frame structure is the contextual time frame. And this time frame is used to define or identify a proper market context and a dealing range on the contextual time frame that you would have chosen. In this case, we can only have one particular or specific time frame for it, right? The contextual time frame can only be one, and for us within the access system, that contextual time frame is the 4 hour, right? I've already discussed what are the reasons behind that, but just remember that. And then once you've defined the market context in the dealing range on the contextual time frame, we then move on to the lower time frame. And again, we can only have one selected time frame for this one as well. And this time frame is used for execution. This is where we take our entries. This is where execution happens, right? Now, what you can see within this three time frame structure is that each part has its own specific job. And when they are all working together, when they are actually aligned with each other in this particular way, that's when you get a technical edge in your system. And that's when you have a mechanical element in your system, right? That's what actually leads to you having a technical edge. That's what a trading or a technical edge is derived from. And without this structure, you can't derive a technical edge or a trading edge. Now, within the access system, the time frame elements is this right here. For the higher time frame, I use the monthly, the weekly, and the daily time frames, right? And I use these three time frames to establish a directional bias. Then once I've established that, I then move on to the contextual time frame. And for that, it's and the contextual time frame for me is the 4 hour time frame. And once I've done my job on the 4 hour time frame, or the purpose has been done on it, then I move to the lower time frame. And for us, that is the 15-minute time frame. Now, I stretched this too long and talked about it for a lot of time, but that was needed. And now I hope and I can be sure that you understand what time frame element actually means and why is it used in the way it is used and what's the rationale behind it. Now, next up we have market structure. So let's discuss that. So, first of all, I'm going to define what market structure is. And the most basic and simplistic definition that I could come up with is that it's the basic framework or the fundamental framework that price moves within. This is how I define market structure. Now, market structure is the first thing that you start your analysis with. This is where you start and where you start to begin, or you begin to make a sense of the direction of price. Now, the most important question that I've heard on Twitter and other platforms regarding analysis is that people don't know where to start their analysis with, right? They know all about these core concepts or these ideas, but when they look at the charts, they don't know where to start or where to begin their analysis with. Now, the answer to that is right here. I'm telling you that you start your analysis with market structure, and this is how you begin to make a sense of the direction of price, right? This is where you start with. Now, honestly, this is also where a lot of traders starts getting confused, and not because it's complicated or this concept is complicated, but because there's just too much noise and nuance out there, and too much unnecessary noise out there. You'll hear people define market structure in 10 to 20 different ways. Some people are tracking every single swing and high like a puzzle, and others are drawing random boxes on the chart and calling them market structure with zero context. And I'm not trying to trash or shit on anyone's approach, but I'm going to make things clear for you here and give you a simplistic and an objective approach. I'm gonna keep this as simple and as practical as possible within this chapter. Okay? So, in the access system, market structure comes down to just two key things. It has two core components. Number one, our first purpose or our first objective or function, or our first objective and the first function of market structure in our analysis is to define structure, which means identifying the current trend and the current direction of price, right? Are we making higher highs or higher lows, or is it the opposite? And that gives you a directional read and tells you whether we are bullish or bearish, right? With market structure, your first objective or the first function of this concept right here is to define a structure and make a directional sense of price. The second component or the second part or the second key thing here is confirming structural shifts, which means detecting breaks in that trend or basically spotting shifts in structure and identifying and recognizing when the underlying trend is breaking down or it's shifting or it's changing or it's having a delivery shift. That's the second core component or key thing or key function of market structure. And both of these components, defining structure and confirming shifts, are based on one simple thing: tracking key highs and key lows, right? Not every candle, not every swing, but just key highs and key lows. Now, if you've seen market structure explained in 50 different abstract and vague or arbitrary ways, now what I'm going to tell you here is that forget about all of that for now and just stick to what I'm about to teach you about market structure in the next few slides. And I can assure you that once you start reading structure or start approaching market structure in this fashion, in this way, in this approach, everything else in the system will start to make more sense for you, and you will actually understand the fundamental and the essence of it. So let's move on. In this slide right here, I'm first of all going to show you exactly how to define structure in a proper manner. Now, what you are looking at right here are just two basic examples, right? They are pretty obvious. We've got an uptrend and a downtrend. Now, let me be real with you for a second. Most people, and I mean most people, will look at this and go, oh yeah, I can just eyeball it. I can just see it. I can see the slope. It is going up and that one is going down. And show visually, optically, it does make sense. But the problem with that is that's not objective. That's just you interpreting it based on how it looks, and that doesn't work on uh, real charts or live charts or in real market conditions, right? It wouldn't be as clean sorry, and as smooth as that. And if your approach isn't objective, that would mess up a lot of things for you, right? And within the access system, we're not going to approach these components or these elements or these factors through subjectivity, right? Through vibes or through optics or through feelings. That's not how we're going to go about things. Instead, what we'll do is we would approach everything with structure, with mechanicality and objectiveness, so that every single element within it is clear, objective, and most importantly, it's consistently repeatable and replicable. That's what our objective is going to be. Okay? Hope that's clear. So, here is how we actually define structure the right way using key highs and key lows. Now, the basic idea is that if price is consistently breaking highs and rejecting below lows, that's an uptrend. And if price is consistently breaking lows while rejecting above highs and having these liquidity purges to take out liquidity and then expanding lower, then that's a downtrend. Right? That's it. You can see within this uptrend, you have price breaking above highs consistently and sometimes rejecting below lows and then expanding higher. Right? That's it. There's no need to complicate this even more. Right? You don't need to sit around counting every candle on the chart or come up with different 10 different rules to decide what trend we are in. This is the cleanest and the most efficient way to define structure, and it actually holds up when the markets get noisy. Okay? Now, obviously, this isn't the full picture, right? We will still be combining this with the other tools later in the chapter to build a complete directional bias, but this right here is where that process begins. Now, obviously is the keyword right here. Obviously, you can't just build a directional bias through market structure, right? That's not just going to happen. That's not possible. You can't build a directional bias with this right here. But what you can build is a directional idea, right? Not a bias, but a directional idea. And once you've built that directional idea, once you build a sense of the direction of price or the sense of the trend of price, then we're going to combine it with the other concepts and the other pillars that are ahead of us. And then we will use them together to build a directional bias from this directional idea. Okay? And right here in this first step, this first component, you start with defining structure. And once you've defined that structure, it gives you clarity on the direction of price, and then you build from there. Right? This is how it works. Now, let's move on to the next part. Okay, so we've talked about how to define structure. Now, let's talk about how to confirm structural shifts. Now, honestly, this might sound a bit more complicated than it is, then it is, but it's actually super straightforward. All you are doing is watching to see whether price closes below a key low in this case or closes above a key high, and that's what signals a shift in structure. But where most people gets confused is that they will ask, okay, what's the difference between a key high or a normal high, or a key low or a normal low? How is a key low or a key high different than any random high or low? Right? How can we do that objectively in a mechanical way? And the answer to that is that a key high, no, the answer to that is that a high or a low becomes key when it's the one that most recently broke structure. For example, in this case right here, you can see that this low right here led to this high being broken. And when a low breaks above a high, if price breaks above a previous high, then this low becomes a key low. And if price then closes back below that key low, then a structural shift happens. But if price closes below a normal or an ordinary low, which hasn't yet led to a high being broken, or which haven't yet broken up above a high, then that's not a structural shift, right? And in the same way, you can see this low led to this high led to this low being broken, and once price closed above and broken through this high right here, a structural shift happened, and then a new trend started. But it doesn't just end there. Yes, that's the important part that you need to remember, and you need to consider and recognize that it must be a key low or a key high for it to be considered a valid structural shift. But apart from that, the most important part here is that a structural shift is only valid when it happens in the right context, in the right market context. And what I mean by a right context is that it has to occur at a key level. There must be a premium key level right here for this structural shift to be considered valid. It also has to occur at a key time, and if it would be more appreciated if it has an SMT with a correlating asset or pair. Now, if you are a new student, you might be wondering what is a key level, what is an SMT, and so on, because we haven't yet discussed them. But you need to remember that a structural shift is only valid if, first of all, it's a key low or a key high, and second, it must have happened at a right context or at a correct context. Otherwise, it would be just a simple liquidity purge below a low. Okay. Now let's look at a live chart example of it. And on that chart, I'm going to first define a structure for you, and then I'm going to show you what is the difference between a key low or an ordinary low, or a key high or a normal high. And then I'll also show you some examples of structural shifts. And yeah, that's what I'm going to do now. Okay, so we've got this EU chart right here. With this example, I'm going to show you, first of all, how to define structure, and then I'll show you how to confirm a structure, and I'll also show you how to differentiate between a valid structure and an invalid structure, right? That's what I'm going to show you with this example right here. So first of all, let's assume price tested a key level, a high time frame key level right here, and from that high time frame key level, we had this expansion. Now you might be wondering, Sham, we didn't discuss we haven't yet discussed key level, or we don't know about key level yet, and how could this move begin from here. Now there's a lot of nuance to that, but we're going to forget about that for now, and I'm just going to show you what is actually happening here, and then maybe further on in the chapter we will discuss this example here, and I'm going to explain it to you with the key level understanding and how this expansion began and what was its relation with the weekly and the daily time frame or the monthly time frame. But for now we're just going to assume that this expansion eroded from a higher time frame key level, and with this expansion right here, with this expansion swing, we broke above a high, right? We broke above a high, and then we broke, rejected below a low. Now this is a bullish market structure till here, and I'm going to show you why. Till this point, this is a bullish market structure because price is rejecting above a high and it's rejecting below lows, right? It's breaking above highs and rejecting below lows, breaking above highs and rejecting below lows. That lows could either be in the form of swings right here, or candle range lows, right? That's important. Again, we're breaking above highs and rejecting below lows and breaking above highs again. And from that point on, we then had a structural shift, right? This is a bullish structure because we are rejecting above highs and now breaking above highs and rejecting below lows consistently over a period of time. And then in the bearish structure, we are breaking below lows and rejecting above highs and then breaking below lows and then rejecting above highs and continuing that process until a structural shift happens, right? That's what's happening here, and that's how we build a directional sense of price action. This is how we objectively define structure or recognize structure. Now, one thing you may have noticed here is that how is this a structural shift when price closed below this low, and how when price closed below this low, this isn't a structural shift? Why didn't price move straight away lower from here? Like from here, why isn't this a structural shift, or this right here isn't a structural shift even though price closed below this low, but this is? The point I was trying to make here is that why is this a valid structural shift when price closed below this low, but this one isn't, this was in it, this one also isn't even though it closed below this low? And the answer to that is because this is not a key low, this is also not a key low, but this is a key low. And the reason this is not a key low is because this low right here hasn't broken any structure or hasn't broken any high. So let me explain it to you right here. So we've got this, let's say we have bullish structure. So right here you can see that we've got these highs and lows. Now within this structure there are only 3 key lows. Now this right here is a key low, and the reason it is a key low is because it has broken above this high, and this isn't a key high because it hasn't broken below a key low. So this is a not a random, but we would say, let's call it a normal or ordinary or just a high. This is just a high, but this is a key low. This is just a high, but this is also just a low. And the reason it is a low is because it hasn't broken above any highs. This low hasn't broken any structure. And once price closed below this low, this wouldn't have been a correct structural shift is because it closed below just a low. All right, and you can see, and this would have been regarded or considered as just a liquidity purge and then an expansion afterwards. Then again, this is a key low because it broke above a high. This right here is just a low and price closed below it. This isn't a structural shift because this is just a low, not a key low. Again, price went higher, broke above a high. This is a key low, and right here again, this is just a low because price didn't broke in structure, but this low right here is a key low. And when price broke below this key low right here, this is when a structural shift happened. This is when this structural shift would have been considered a valid one. And after that, price then started a bearish market structure. So similarly, in this example right here, you can see this is a kilo, right? This is a kilo because it broke above this high. But this right here isn't a kilo because it didn't do shit. It didn't broke above a high. So when price closed below it, this wouldn't have been a CSD or a structural shift. This is just a random liquidity purge to take out liquidity, and once that liquidity was taken out, we then had an expansion higher and broke above a high. Now this is a key low. If price broke below this low, then we will start our structural shift, and then we will start a bearish structure, but that doesn't happen. Instead, price continues the bullish structure, which means that unless a structural shift happens, your expectation for price would be to continue the structure, right? You can't just force price to and you can't just expect price to break a structure just because you are expecting it or just because you want it to do that. Unless price has a structural shift, you're gonna keep expecting higher prices, or your traditional idea of price would be a bullish one. Again, it broke, rejected below a low, right? It rejected below a low, but it wasn't a structural shift because first of all, it didn't close below this candle range low, and second, this candle range low wasn't a key low. And then it continued that. Even here we had a invalid structural shift, or what I'd call a liquidity purge, because this wasn't a key low, this was just a low. And after that, we had this expansion above, and with this expansion, we broke above a high. Now, a broke above a high, this statement may seem that price has to close above a high, but that's not necessary. We just have to peak above it or below the low, respectively. In this case, this low led to this high being broken. So when price closes below this low right here, just because this is a key low, this is now considered a weathered structural shift, and from that point on, you can see price then continued the bearish trend. So this is why these two weren't weathered structural shift, but this was because of the concept of key highs and lows. Now there are a lot of other factors here playing out as well, like there is a higher time frame key level here that led to this expansion, or there is a higher time frame discount key level that led to this bullish expansion or this bullish trend. But this is how we build a directional idea, a directional sense of price, right? This is not a bias. We are not talking about a bias or determining drawn liquidity here. I'm just showing you how to build a directional sense of price or build a directional idea, and then we will build that directional idea into a directional bias using the other factors, using the other variables, using the other elements, using the other pillars and concepts and stuff. Okay, now I hope you understand the basics of market structure and its two different components and how they work. So the next component or foundational pillar that we have is market profiles. Now here's the thing. Market structure in itself is pretty good. It gives you the basic trend framework that price is operating within, and along with that, it also lets you track directional shifts in the market. But just like you saw in the live example earlier, you just saw the charts and you saw that the real an actual price action on the charts isn't as simple as that, right? There's a lot more nuance to that, and market structure alone does not give you or tells you the full story about the markets or about price action. Market structure alone won't tell you. What essentially I'm trying to say is that market structure alone won't tell you what the market is actually trying to do on a daily basis, day in, day out, or where in the move we actually are, right? That's the limitation of market structure. And in order to compromise for that, or not compromise, or in order to solve that problem, or to solve that question, or to solve that aspect or that element, that's exactly where market profiles comes in, right? Now, if I had to define market profile for you, it would be this right here. Market profile gives us a more refined and honestly a way more dynamic way of reading price. Now, it goes beyond the limitation of traditional market structure or traditional higher highs and lower lows type of stuff. Instead, it helps us understand the phase that the market is in. So market structure helps us build or establish a directional idea. It tells us the direction of the market, but market profiles tells us and helps us understand the phase that the market is in. Now, the thing is that sometimes, actually not sometimes, but most of the times, you could have the correct direction of the market or price. But the reality is that price does not just move in a straight line higher or a straight line lower. You just saw that in the example. Instead, it moves in phases. And if you are using just market structure alone, then you're going to be wrong most of the time, because with market structure, your expectations would always be one-sided and incomplete and unfinished, right? You'll always be expecting price to move higher or lower in a straight line without understanding the intricacies and the nuance of price action. But with market profiles, you'll actually get to know about the phase or the profile, right? You will actually get to know about the profile that the price is operating within. And that way, your decision about directional buys and your directional buys would be much more informed and much more structured, right? That's what market profiles help you with. Now, inside Axis or the Axis system, obviously, we use market profiles in conjunction or in integration with market structure. Structure helps us build an idea, and then profiles or market profiles helps us either confirm or invalidate that idea, right? And it helps us do that by assessing and measuring where we are or what phase the market is actually operating within or sitting in. That what that's what market profiles helps us with. Now there are two ways that we can interpret market profiles. The first one is the basic way of interpreting it, and that approach, you've got ranging profile, and that's basically when price is moving sideways or it's in consolidation. We've got the expansion profile, where the market breaks out and starts expanding in a particular direction. Then we have a retracement, where price pulls back into a previous range or a previous key level. And then we have the reversal profile, where the entire trend changes. The reversal profile starts when a structural shift happens, when a valid structural shift happens, right? Each one of these profiles that you can see, these profiles helps you understand what phase you are dealing with, and then that in turn tells you what to expect next. Now, the idea here is that even though price could be in an uptrend or in a bullish structure, but it'll still have these different phases and different profiles. And you can't just trade each one of these phases right here. Instead, some of these phases or profiles will act as a filter for you. And then what you're going to do in those phases is wait for the right profile before you actually trade it. And that's where the concept of probability comes in, right? That's how you differentiate between high probability and lower probability conditions, or um, lower probability what conditions, probability, lower probability price action essentially. And if you're not aware of market profiles, or you're not using market profiles in your analysis, then that way you wouldn't know about these phases, about these different profiles, and you would incorrectly and ignorantly try to trade every sort of price action with the premise of you thinking that you know the directional structure, which obviously alone is not enough. And that way you could try to trade the retracement profiles and also the ranging profiles, and you in a bullish structure, and you'd end up losing. And then you'd be wondering what the fuck happened, even though you knew about the structural direction of price, when in reality the truth was that you wouldn't have been aware of the fact that there are also these different profiles that exist. And if you try to trade an incorrect profile or a lower probability profile or phase that you're not supposed to trade, then obviously that's an invalid approach, or that would be considered invalid. And to avoid that, we use market profiles. That's the entire essence of market profiles. Okay. Now, the second way we interpret market profiles is through power of three, the power of three concept. Now, this one right here is a bit more advanced than logic, but once you understand it, it's insanely useful. It's really useful for you. So, in this sort of interpretation or this sort of approach, you've got three advanced profiles. The first one is the ranging or consolidation profile. Then we have the manipulation profile, where price takes out liquidity, purchase liquidity either below or above the range high. And then we have the actual expansion, and that's where the real move occurs, right? And these things right here basically gives you a story, a sequence. And if you can read that sequence properly, then it tells you exactly where price is in this cycle right here, or maybe in this cycle, and then your decisions about the direction of price or the profile or phase of price would be much more informed. The next thing is that each profile framework, right? We've got the basic profile framework and the power of three framework. Each one of these, and then the sub profiles within each one of them, have their own sequence logic and their own potential outcomes based on the later logic, right? They've got their own pattern of behavior and their own set of likely outcomes. And we'll break these outcomes and these characteristics individually in the next few slides. But for now, just understand that profiles are what add depth to your structure reading. Structure tells you where we are, and market profiles tell you what's happening there. Okay, that's the entire essence of market profiles. Now let's move on to the next slide, and first of all let me explain this basic profiles to you, and then in the slide after that I'll explain this power of three framework to you. So in this slide you can see we've got these two price actions right here, one on the left and one on the right, and I'll try to explain, or I'll help you understand the basic profiles framework here. Now I can't draw on the chart here, that would have been much more helpful. You see, now I cannot draw here. If you know about any platform or any software that helps me draw here, then let me know in the DMs, because it would have been more useful if I could draw lines here, but I can't. But forget about that for now. Let's discuss the basic profiles framework. So you can see, uh, if we break this price action down, then we can see it's in a bearish structure because it's breaking below lows and rejecting above highs. Now we know that the directional idea here is that price is bearish. We right, because of structure we know that the direction is bearish. We know the structure because of market structure, because of using market structure. But just as I said before, just as I said earlier, that alone isn't enough. So what we're going to do here is I'll break this price action down based on the basic profiles framework. So first of all, you can see price is consolidating here, right? It's not breaking out of this range right here, and this price action, this small range of price action represents a ranging profile or a consolidation. It This ranging profile continues for a while, and after sometimes sometime we then break out of this range with this move right here, and this move represents an expansion profile. After an expansion profile, we then have a retracement profile. Now if you're wondering what leads to an expansion profile, or what leads to a retracement profile, or how can we predict that, or how can we recognize that, then that's another lesson, right? That's another lesson for some time, and I'll explain that to you in later chapters. But for now, the essence here is that the premise here is that price does not move in a straight line. Even though the structure is bearish, it still has these retracement moves, or these pullback pullback moves, where price goes against the intended direction or the actual direction of market. And because of market profiles and because of the basic profiles framework, we now have the ability or the competency to break this down and understand and figure out that this exists. And then we can use this understanding or this knowledge to our advantage. So after the retracement profile is completed, we then have another expansion profile, then a retracement profile, then expansion and retracement. Right? This is now, before market profiles, you would have just had this idea that the structure is bearish, and then that would have been it. But now with market profiles, you can break this structure down even more, not just using highs and lows, but using profiles and phases. Each one of these profiles and phases have their own time period, their own characteristics, their own potential outcomes, and their own qualities. Now, if we talk about the ranging profile, then within a ranging profile, we can only have an expansion or a manipulation. We will discuss the manipulation part in the next slide, but a ranging profile can only have two potential outcomes. In this case, in this basic profile framework, it can only have one potential outcome, and that is an expansion. Once an expansion is completed, the only not the only the three likely outcomes we can have is either a retracement profile, another consolidation profile, or a reversal. In this case, we had a retracement profile. Once this retracement profile is completed, now if you're wondering how does a retracement profile completes gets completed, or how does it end, and how can we know that, then just like I told you earlier, I'll explain those intricacies and those details to you in later chapters, but just understand this for now. After retracement profile ends, the only outcome we can have is an expansion profile. Okay? After retracement profile, we cannot have a consolidation. We cannot have a reversal. We can only have an expansion profile. That is the only possible and that is the only likely outcome for price action in that case. Okay, and you can see price continued moving in that fashion, having retracements and then expansion, then retracement, then expansions, and it continued towards the downside. Now there is nuance into why price forms these retracements or rejects above a high, or it retraces until here but not here. There is nuance to that, and we'll discuss those details later. But right here, just you just saw how I broke down this price action with basic profiles framework. And with the help of that, it helped you understand this price action much better than market structure. Then on the right, we have another ranging profile. We then have an expansion, then a retracement, then another expansion, then a retracement, then an expansion. And once this expansion ends, we then have a reversal. The factors that could have played out here is that maybe we have a premium key level right here, the price tested, or maybe price finally reached the drawn liquidity. And once that occurs, once those factors are aligned, once those elements are aligned, after that we have a structure shift. And once the structure shift is validated, a reversal profile happens, or a reversal profile starts. Okay, this is the basic profile framework, right? We have 4 profiles within it: the ranging profile, the expansion profile, the retracement profile, and the reversal profile. The other framework that we have is the power of 3 framework. Now this one, just as I said before, this one is a bit more advanced than the previous one, because this narrows down the 4 profiles into just 3, and it gives a much more refined view to profiles, to market profiles. So right here you can see we are in a ranging profile first of all. Then after the ranging profile, we have a manipulation profile, and profile does is that it takes our liquidity above the range high, maybe the tested key level here, and then it expands lower. And once manipulation profile is completed and liquidity is taken out, the only likely outcome, or the only possible outcome that we can have, is an expansion profile lower. And then within that expansion, we can have these minor retracement profiles. And right here again, a ranging profile, manipulation profile, then an expansion, retracement, then another expansion. Right? These are the 2 frameworks: the basic profile framework and the power of 3 framework. So now we're going to move on to the next topic, which is the concept of liquidity metrics. Now, if you're wondering where is the live example of this concept, then first I'll discuss the liquidity metrics topic, and then once I've done that, then I'll give you live examples of both this topic and then the next one, both in conjunction with market structure. So it'll help you understand price action even better, and it'll help you understand these topics better. So let's talk about liquidity metrics here. Now, here's something important to understand before we even get into the details. All of these concepts that we've been discussing and covering so far, that I've been covering so far in this chapter, whether it's market structure or whether it's market profiles or this one right here, these concepts do not work in isolation. What I mean by that is that when these concepts are used alone, they do not work, right? They are not meant to be used separately. Instead, they bring meaningness to them when they are built on top of each other. When they are used and integrated with each other, that's when it actually brings clarity to your understanding. Okay, we first of all start with structure. We start our analysis with market structure, and that helps us understand the directional framework or the direction of price action. Then we use market profiles to get a sense of the phase or the cycle that price is operating within. And once we've done that, then we bring in liquidity metrics on top of that to refine that directional idea even further, right? That's how we use these concepts together, right? They're not meant to be used alone. So first of all, let's discuss, what does liquidity metrics actually do? How can we define that? And this most simplest way I can define that for you or tell you that is that it helps us identify where major pools of liquidity exist, and then how prices interacting within them or with them, right? That's the simplest way to sum up liquidity metrics or to sum up what it does. Now, just like I told you earlier, with market structure and market profiles, you build a directional idea, and then with the liquidity metrics and dealing ranges that we will discuss in the next slide, you can change that idea and turn into a directional bias. Okay? Liquidity metrics along with dealing ranges and key levels that we will discuss in the later slides, when those things are combined with each other and they are integrated with each other, it lets you or it helps you establish or build or form a directional bias from the previous directional idea that you built with market structure and market profiles. That's the purpose or that's the function of this concept right here. Okay. Now let's move on to its components. The liquidity metrics concept or pillar has two components or two key things about it. First, we have external range liquidity, which is represented by highs and lows. These are key highs and lows. And then we have internal range liquidity, which are represented by blocks and gaps. Now, if you're wondering what is a block or what is a gap, we will discuss them later in the key level section, and then you'll know what it actually is. But just understand that internal range liquidity is represented by blocks, gaps, or you could say key levels or key levels within a dealing range. What price does is that it shifts back and forth between ERL or external range liquidity and IRL or internal range liquidity until a structural shift occurs and then the cycle changes. That's the entire essence of liquidity metrics. And again, just like I said earlier, we're not using this as some separate tool. What we're doing is we're integrating it into everything else that we discussed so far, whether it's market structure, market profiles, or the next topic that we're going to discuss, right? And these things together helps us build a directional narrative that actually makes sense. And then you'll have the most accurate, the most precise, and the most refined understanding of what price is trying to do and what it has done in the past or what it will do in the future. Okay, now let's move on. So we can see these two graphics right here. We have a bearish structure and a bullish structure. In the bearish one, we can see that once we had this expansion right here, we then had price retrace back, test some sort of key level. It could have been a block such as an order block, a rejection block. It couldn't have been rejection block because rejection blocks are right here. but it could have been an order block, a propulsion block, or maybe a gap, such as an opening gap or a fair value gap. And just like I told you earlier, internal range liquidity is represented by blocks and gaps, and those blocks and gaps exist here within this expansion swing. And the opposing ends of this expansion swing or this expansion move, the opposing ends are represented by external range liquidity, right? These extremes could be considered external range liquidity. So we've got external range liquidity. Price with this expansion took out external range liquidity below this low, and once the external range liquidity is taken out, the next most likely thing that price does, or what price is then inclined to do after external range liquidity is taken out, is that it fills internal range liquidity within this range. And in this example, you can see once internal range liquidity was filled in the form of testing a key level within this gray area, it then started another expansion move and continued its journey lower and took out another external range liquidity. And this right here answers our previous question, which was that how do we know that a retracement profile ends? How do we recognize when a retracement profile ends, or how do we know, or how do we identify that that a retracement profile has completed? And the answer is right here. Once an internal range liquidity, once internal range liquidity has been filled within an expansion profile or within a dealing range, that's when the retracement profile completes, and after that we begin a new expansion profile, and with that expansion profile our objective is to take out external range liquidity, in this case this low right here. And similarly in the bullish example, again price takes out external range liquidity and then it retraces lower to fill internal range liquidity, and unless and until that internal range liquidity is filled, price would just keep going lower. If the internal range liquidity was somewhere right around here, then price would have gone down up until here, down until here, no pun intended, and then after that it would have had an expansion profile later. This framework also answers our another question, which is that once a retracement profile is completed, what is our next target? And the answer lies right here. Once a retracement profile ends, after filling our internal range liquidity, the next likely target for us is the external range liquidity that led to this retracement profile. Okay? This is liquidity matrix, and this is how we break down price action with it. Now it may seem a bit too simplistic to you right here with these examples, and I know I can see that, but once I show you some live examples of it working out and it helping you understand price action better, then you will understand the significance and the importance of it. Okay, I'm moving on. In this slide right here, we're going to discuss and talk about the topic of key levels. Now, before we get into the technical stuff, let me first of all define what key levels actually are in simple terms. And yeah, I know some of you probably already know what they are. You may have watched a bunch of videos on it or may have taken a bunch of courses on it, but I'm still going to walk you through it from scratch just so we are all on the same page. Because at the end of the day, this is an important part and a core component of the Axis system, and I don't want to assume anything or skip over it too casually. Okay? So, the simple definition of a key level is this. They are critical areas or important areas in price action. They are important areas or zones that acts as a catalyst or triggers for major reactions or major expansions or range expansions in price action. Now, if you look at the time frame alignment between different time frames and how price behaves within it, then you'd see that on the lower time frame, the major expansions or the major reactions are produced off of higher time frame key levels. And you could use this information to better align your entries or to build a directional idea on the higher time frame regarding where price could potentially go. And just like I said earlier, these key levels are a core part of the entire Access Foundation. And the reason is that they are one of the only few foundational concepts that shows up in all three components of our analysis. It's something that's integrated into every single part of how we analyze the market. Now, if you're wondering, wait, Sham, what are those three components that you're talking about? Then don't worry about it right now. We will cover them. We will cover that topic fully in chapter 2, and you'll then understand what they are, what those components are. But for now, just keep this in mind that key levels not only helps us with building or establishing a directional price, but also they helps us time our entries on the lower time frame and helps us frame our entries based on specific market context. Okay, and those contexts in itself are made from key levels and dealing ranges. That's something that we will discuss in chapter 2. Now, regarding its types, key levels have two main types. Now, technically, we've got a bunch of different kinds of key levels, but if I had to break them down into just two broad categories, then there would be two types that everything falls under. The first one is blocks, and that includes key levels. Sorry. That includes key levels like order blocks, breaker blocks, mitigation blocks, or propulsion blocks. Now, each one of these each one of these key levels are formed in its own capacity, right? They have their own behavior and their own structure that they are formed within, which we'll discuss later. But this is the first category or the first type of key levels, which are blocks. The second one is gaps, which includes fair value gaps and or opening gaps. And depending on the context, there are a few others as well that we will discuss. Now, the thing that makes each type different and leads to the discrepancy between them is not about the capacity that they're formed within, but also how price interacts with them and how they shift the market context when they come into play. Those three things, the formation of a key level, the interaction of a key level with price action, and what sort of context it leads to, these three things, these three key aspects or elements, those things are what creates all the nuance between these different kinds of key levels. And that's why you can't just treat all of those key levels the same, right? You can't just go that, okay, that's a block or that's a grab and just slap your buys on top. You have to understand how that key level came into existence and what role it plays in the structure and how price is behaving around it now. Okay? You need to remember that. Now we will go deeper into each one of them in the next slides, and I'll show you what they look like and how they behave in live charts and how to actually use them. Okay, now let's move on and let's discuss the categories of key levels. The first category that we're going to discuss are blocks. Now we have different types of blocks. We have an order block, a breaker block, and a mitigation block. And the main difference between each one of them is the way how they are formed and how price interacts with them and what sort of context does it leads to. So an order block is basically a key level, and that key level perpetuates itself in a form of a candle which either takes out liquidity, meaning it purges liquidity, or it generates liquidity, or it fills liquidity. In this example right here, we can see that this particular candle has taken out liquidity below this low. And by taking out liquidity, I mean just peaking below this low or taking out this low. This particular candle has taken out this low, it has purged below this low. And now when price closes above it, when price engulfs it, this candle turns into an order block. This is how an order block is formed. There are two protocols for it. First, it has to have a certain behavior, a specific type of behavior, and that behavior could either be in the form of price taking out liquidity in this example right here, or filling liquidity in the form of a fair value gap, or testing another key level in the form of this order block or this order block, or generating liquidity. When a candle does either of those things or shows either of those behaviors and then that candle gets engulfed, that's what we call an order block. In this case, price has purged liquidity, then price closed above it, and we formed an order block. Price then tested this order block and expanded higher, and this order block was used as a catalyst for this expansion. Now if we look at the lower time frame price action of this move right here, we would see that on the lower time frame this key level led to this expansion. Now on this time frame, you can see that it is just a small move higher, but on the lower time frame, if we see this move, it would be a major expansion. Now I'll said that this is also a key level in order block specifically, and the reason for that is that, and also I forgot to mention one important thing. An order block isn't just a single candle, it could also be a consecutive group of candles, right? If a consecutive group of candles or a single candle behaves in that specific way and then it gets engulfed, then that turns into an order block. It could either be a single candle in this case or multiple candles in this example right here. So now let me tell you why these two candles makes up an order block. So the first thing is obviously its behavior. You can see that these two candles together filled liquidity, and what I mean by filling liquidity is that these two candles together tested this breaker block, meaning it filled liquidity. So the first protocol is followed, which is its behavior, and the second protocol is its engulfing behavior, which is that these two candles, the two candles that had a specific behavior, they got engulfed, and that in turn led to the formation of this order block. In this case, the order block is made up of these two consecutive candles. So that is how an order block is formed and how price interacts with them. The second type of key level that we have is a breaker block. A breaker block is a candle or a group of candles at a swing high that leads to a low being taken out, and once that high then gets engulfed in the price in the form of price closing above it, that in turn leads to the formation of a breaker block. In a bearish example, a breaker block is a low that takes out a high and then that low gets engulfed. That leads to the formation of a bearish breaker block. In this example, we have this candle, and from this candle we started this expansion move lower, and with this move we took out liquidity, we took out this low, and then price expanded higher, reversed higher, and closed above this particular candle, and that led to the formation of this breaker block. Now, breaker block and mitigation block are pretty much the same. The only difference is that a mitigation block forms a low, but just before taking out the low or taking out liquidity or purging liquidity, it stops and then price closes above it, and then it leads to the formation of a mitigation block. Now, there is a specific reason for why price does that sometimes, and that is the concept or the idea of SMT divergence. Now, we haven't yet gone through the SMT divergence part, so you might be a bit confused. But once we go through it, then you'll understand why we had this move, why price didn't purge this low in this case, and but it did in this case right here. But the only difference is the name and the behavior. A mitigation block is pretty much the same, but the only difference is that it doesn't takes out a high or a low, respectively. But the similarity is that it then gets engulfed and then price tested and then expands higher from there. This is the comprehension of the blocks category of key levels. Now let's discuss gaps. Where is it? Next up, we have the second category of key levels, which are gaps. Now, gaps include key levels such as fair value gaps, inverse fair value gaps, or opening gaps. And those opening gaps could either be in the form of daily opening gaps or weekly opening gaps. Now, opening gaps are much more apparent or much more common on indices, and as we are focused on forex in this chapter or within the access system, I'm just going to discuss the inverse fair value gaps and ordinary non fair value gaps here. Now, the formation of a fair value gap is simple. It is formed after price either purchases liquidity or fills liquidity. In this case, you can see price has purged liquidity, and once that liquidity is purged, it then leads to the formation of both an order block and also a fair value gap. And a fair value gap is when three candles are positioned in a way where the wicks or the bodies of the second candle do not matches or do not touches the wick or the body of the third candle, and that in turn leads to this gap, and this gap can be used as a key level. What price does in this sort of situation or in this sort of instance or scenario is price takes out the high of the third candle and fills that gap, and once that gap is filled, once that liquidity within that gap is filled, price then expands lower. Okay, this is an example of a fair value gap. An inverse fair value gap is pretty much the same. It is formed in the same manner, but the only difference is that once that gap, the initial fair value gap, gets engulfed, it can then be further used as an inverse fair value gap in the opposing side. So in this case right here, you can see we have this initial fair value gap formed here. Now, if you're wondering how is this a fair value gap, because we purged liquidity below this low, and then that in turn led to the formation of this gap. And this is a fair value gap because these three candles are positioned in a way where the high or the wick of this candle does not touches the lower wick of this candle, and there is liquidity to be filled here. But let's assume there's a premium key level here and price has tested that, and that led to this structural shift. And because of this structural shift, this bullish fair value gap got invalidated because of this structural shift. And in that scenario, in that case, you wouldn't have used it because of the higher time frame context. And in turn, this fair value gap turned into an inverse fair value gap. And you can see that it's in the opposing dealing range of this expansion swing or this range expansion. And you could have used this fair value gap for either building a directional bias or timing your entries. Now let's say this is a daily chart. Let's say price closed here after testing the key level, then in that case you would have recognized this fair value gap, and not only this one but also this inverse fair value gap. And let's say this is the Monday's candle. The Monday's candle formed the range. Then on Tuesday you would have expected price to form the high of the week inside a higher time frame key level, and this would have been the key level in this case, this inverse fair value gap and this fair value gap. And what you can see is that on Tuesday price took out this high, took out Monday's high, formed the high of the week, and once that high was formed, we then had a range expansion lower, right? On Wednesday and Thursday we had a range expansion lower, and then right here you can see we then had a small retracement on Friday, which is what we call a TGIF, or a Friday retracement profile. And this is based on the open high low close concept, which we'll discuss later. But you can see right here how all of this starts to make sense when we used all of this together, right? When you use the key levels, the time frame alignment, and all of these concepts together, it starts to make sense. All right. So in this slide, I'm going to break down dealing ranges for you, what they are, why they matter, and how we can actually use them within our access system. Now, first of all, the definition is super simple. A dealing range is basically just the area or the zone between a significant high and a significant low. And what that means is that anytime we get a strong expansion swing, and then when we divide that expansion swing into two regions, those two regions together make up a range called a dealing range. Okay, those two regions together becomes what we call a dealing range. Now it's not complicated, but it is extremely important. And the reason for that is that dealing ranges not only help us define market context, or you could say help us understand where we are in the market contextually, or where price is in the market contextually, but also it helps us set expectations more accurately. Okay, that's the main thing. It helps us frame our intentions with a much more informed view and with a much more informed perspective. Like, it helps us understand where should we even be looking for. And then with the help of that, it directly helps us in planning our entries better and more accurately. And that is why this concept is so central to everything else that we do. This one range, this dealing range, it creates the entire framework for how we view price, where we think internal range liquidity is sitting, and how we anticipate and when do we anticipate external liquidity runs. It helps us with all of these different elements and aspects of our analysis. Okay, that's the importance and significance of it. Now, inside every dealing range, there are four core components you need to know about. These four components make up the backbone of how this range is structured. Now, first of all, we've got the range boundaries, which are literally just a significant high and the significant low that defines the range. Okay, simple as that. Basically, the extreme or the edges of the dealing range. Then we've got the discount region, and that's the area below the midpoint. That's the region below the equilibrium point. And then we've got the premium region, which is the region above the midpoint or above the equilibrium. And last but not least, we have the equilibrium, and that's the actual midpoint of the dealing range, like the 50% level, and it gives you basically a reference point. Okay, now let's move on to the next slide, and let me explain dealing ranges to you on some graphics. So we've got these two price actions here, one on the left and one on the right. What I'm going to do here is, first of all, I'll explain to you how are these two expansion swings dealing ranges, and then I'll tell you how to identify a dealing range, how to recognize a dealing range, or how to differentiate between a simple expansion swing and a dealing range. And then I'll help you understand how a dealing range helps us set our expectations or anticipations for price action or range expansions more accurately and with a much more informed view. Okay, so first of all, right here, let's discuss this one. First of all, you can see that this low took out liquidity below this low, meaning this low rejected below this low. And along with that, this low also led to price breaking above this high, meaning this low broke above a high. And because of these two behaviors, the first one breaking above a high and rejecting below a low, because of these two behaviors, this low is considered a significant low. And just like I told you earlier, a dealing range is made up of a significant low and a significant high. Okay, so now we've got a significant low. The next thing that now we need is a significant high. But before I show you how is this high a significant high, or this high isn't, or this high isn't, let me first explain to you what sort of behaviors lead to a high or a low being considered a significant one. Okay, basically there are three behaviors a low or a high can have that leads to it being considered a significant one. Okay, there are three behaviors that leads to a high or a low being considered a significant one. Now let me explain that to you, or those behaviors to you on a chart. Wait a minute. Where is it? Okay, so we've got this chart right here, and I'll explain to you what are those three behaviors that leads to a high or a low being considered a significant one. So the first behavior is that it has to purge liquidity. So if a high or a low has purged liquidity, then that high or low would be considered a significant one. Let's say we are in a bullish market structure and we've got this low right here. If price takes out this low, rejects below this low, or purges liquidity below this low, and then it expands higher, this low would be considered a significant one. Similarly, in a bearish example, if this high takes out this high and then it expands lower, this high would be considered a significant one. Now in this case, this isn't the only behavior that led to this low being considered a significant one, because this low also led to price breaking above this high. So because of these two behaviors, because of rejecting below this low and breaking above this high, this would be considered a significant low, which brings us to our next point, which is breaking above slash below, meaning if a high, or meaning if a low has broken above a high, then that low would be considered a significant one. Or if a high has broken below a low, then that high would be considered a significant one. Here, let me give you another example. So in this case, you can see that this low hasn't taken out liquidity. This low hasn't purged below any lows, but this low this low has led to this high being broken above. So in this case, this low would also be considered a significant low. Okay. So behavior one is that if it has purged liquidity, then it would be considered a significant one. And the second one is that if it has led to a high or a low being broken above. Similarly, in a bearish example, this low hasn't purged above any high or purged liquidity above any high, but it has broken below a low, so this would also be considered a significant high. Okay. The third one is reaction to a key level, meaning if a high or a low has reacted to a key level, and not just a key level, but a higher time frame key level. If a high or a low has reacted to a higher time frame key level, then that high or low will also be considered a significant one. Now, if you're wondering what does a reaction mean, then let me show it to you. Let me remove all of these. So let's say we've got a higher time frame premium key level here in the form of maybe an order block or maybe a high or a rejection block or whatever. Let's say price is in a bullish structure. What price has done here is that this low has not only rejected below this low, but also it has broken above this high. So this is significant low, but we also need a significant high before marking out a dealing range, or before we could mark out a market context and then set our expectations. Okay, so now we need a significant high. Let's say price does this. Would you call this a significant high? And the answer is no, because this high hasn't purged liquidity. So the first behavior isn't present, or the first behavior isn't uh, hasn't been followed. The second one is that has it broken above a low? Then this high hasn't, because the low is sitting right here, so also isn't. And the third one is, has it reacted to a higher time frame key level? And the answer is no. So because of these three behaviors, because of the lack of these three behaviors, this isn't a significant high. So we wouldn't have drawn out, or we wouldn't have marked out our dealing range or marked out our market context. Let's say price continues going higher and then it tests a key level, and then it reacts to here. And by reacting to a key level, I mean it must form a bearish engulfing candle here. Let's say, let me show it to you. Let's say price tested this, the higher time frame key level, with this candle, and then the next candle, let's say, engulfed the prior one, the latter one. Okay, now you can see that this, you can see that price action reacted to this higher time frame key level, and because price engulfed below this low, from this point on we would have drawn out our dealing range. So now this would have been a dealing range. Then what we would have done is marked out key levels within this dealing range. So one key level we have in this dealing range is this low right here. Maybe we have an order block here. So now we have marked out our market context and our dealing range. And even though the underlying market structure here is bullish, because price is rejecting below lows and breaking above highs, and anyone with the understanding of market structure or liquidity metrics would have just expected a bullish range expansion higher, because the underlying directional idea is also bullish. But because we are using dealing ranges here, and we know when a dealing range is formed, or how is a dealing range formed, and how we can recognize that, because of that awareness, we wouldn't have just expected bullish price action from here like this. Instead, we would have been more cautious of price action, and we would have known that because price engulfed this low and that led to this high being a significant one, this has led to the formation of this dealing range. And when a dealing range is formed, the first thing that price always does, regardless of the underlying market structure, is price has to first fill or rebalance the dealing range. And in this case, rebalancing means either testing a discount key level or reaching the discount region. And in this case, we have, let's say, this discount low below the equilibrium region, which is the discount region, and this is a discount low. So in this case, we would have expected price to rebalance this dealing range by having a retracement profile lower. Okay, we would have had a retracement profile lower to rebalance this dealing range. And once we rebalance this dealing range by reaching the discount region and testing or reacting to a discount key level in the form of taking out this low, then from this point on, we would have then expected a bullish range expansion. Okay, now let's assume this is a daily chart. So if this was a daily chart and you weren't using dealing ranges, then you would have straight away expected bullish price action and you would have been wrong up until this point. But because we were using dealing ranges here and we were aware of the fact that price has to first rebalance the dealing range before having a range expansion higher, because of that knowledge, because of that ability to recognize the formation of a dealing range, we would have been much more cautious of this and we would have recognized the formation or the start or the beginning of this retracement profile. Okay, so now this also answers our previous question about how to know that a retracement profile has started, or how to recognize the formation of a retracement profile, or how to expect a retracement profile. And right here, this is the answer. A retracement profile begins or starts after price forms a significant high and after a dealing range is formed. And a retracement profile ends once we've tested a discount key level or once we've rebalanced a dealing range. Okay, and now right here you can see that I'm actually combining all of the foundational pillars and all of the core concepts that we've discussed so far, whether it's market structure, whether it's market profiles or key levels or dealing ranges. And because I'm combining all of them together and integrating them with each other in a proper manner, that's why the directional bias that I'm establishing here is so accurate and so precise and so informed. But if I had been using all of them in isolation or separately from each other, then the directional idea or the directional bias that I would have built here wouldn't have been as informed and as precise and as accurate as this one. And this goes to show the importance and the significance of integrating these concepts with each other rather than using them separately or in isolation. Okay, and this is how you do it. Now I've just given you a single example here, but throughout the entire exercise cycle, I'm going to be giving you or providing you with trade breakdowns and higher time frame case studies and higher time frame analysis. And I'll be explaining or showing you exactly how to do all of this that I just did in a step-by-step manner with a step-by-step approach. And along with that, I'll also be giving you my own procedural framework that I personally use, and I can assure you that will solve most of your problems regarding your analysis. Okay, now let's move on to the next slide and let's discuss the next topic, which is the open high low close framework, or what some people also call the open low high close framework. Now this pillar or this framework right here is what I call an anticipation framework. And what that means is that it's a way for me to anticipate or have the ability to anticipate what a single candle or specifically a single higher time frame candle might do and how is it going to do that thing that it wants to. Now it may seem a bit vague at first, but let me explain it to you. We use this anticipation framework to break down a candle's movement and specifically a higher time frame candle's movement into different multiple phases and profiles based on both price and time, right? Not just price, but also time. And when you start doing that, that's when your anticipatory skills and your anticipation ability improves, right? Based on this, your anticipatory skills improve. And because of that, you start seeing the possibility of what might unfold inside a higher time frame candle. And that leads you to stop getting surprised by what happens at the beginning or at the end or at the middle of a candle, because now you're expecting it. And that's the key here. Okay? Now the simplest way I can explain this whole concept to you is that each candle, whether it's a 4-hour candle, a daily candle, or a weekly candle, whatever, all of those higher time frame candles can be broken down into multiple distinct in different phases and profiles. And then you can use those profiles to improve your anticipation ability. Now, I'll walk you through exactly what those profiles are in the next slides, okay? But just understand this for now that when you break down a higher time frame candle, you open up this whole new layer of analysis. And due to that, you're not just trading structure anymore, you are trading structure plus time. Now, the best analogy I can give you here is it's kind of it's kind of like a timed version of market profiles. In the previous slides we talked about the power of three framework. You remember that thing, right? Well, the open high low close framework is just like that, but the only caveat or difference here is that we've added a time element to this concept, or we've added a time aspect to it, and that's what make this concept unique than market profiles. Now, in terms of components, this framework has two core components or two main parts. First of all, we've got the profile logic part, and this is basically the price action part of this concept, right? It's literally built on top of the market profile stuff that we've already covered. We've got the ranging profile, then the manipulation profile, and then last but not least, the expansion profile. Okay, you already know this part, and that's basically the price element of this concept. The second component is what I call time anchoring, and this is where you bring the actual open high low close idea into play. You are anchoring your understanding of the candle to the open, to the high, to the low, and to the close of a higher time frame candle, and not just from a data perspective but as reference points for timing trades, building buys, and identifying when and where the range expansion for that particular candle could happen. And this right here, this time anchoring element is what makes this framework its own thing. If this part didn't existed, then it'd just be market profiles or the power of three framework. But because this component exists, it turns this concept into something way more powerful, because now you're aligning both price and time, and that lets you time your execution better. It lets you spot or identify or recognize early signs of reversals or expansions, and make your anticipatory skills even better than it were before. Okay, that's the main premise or the core idea of this concept right here. Now let's move on to the next slide and let me explain this to you one more. So right here, this is basically a typical example of how a higher time frame candle can be broken down into multiple phases and profiles. Now this isn't the only one. We've got other variants of it, variants of how a higher time frame candle can be broken down into phases and profiles. And I'm going to explain those other variants to you sometime later in my trade breakdowns. But for now, I think this one will be more than enough for you to understand exactly what I mean by using this concept as an anticipation framework. Okay. So basically, this is a higher time frame bullish candle. This is the open of the candle. This is the close. That's the high, and that's the low. We already know about this stuff, right? Now, when we look at this candle on the lower time frame, you'll see that when a candle opens here, when a higher time frame candle opens here, let's say this is a daily candle. When this daily candle opens here and you're seeing this, or you're looking at this on the 15-minute time frame, then you'll see that price doesn't just straight away expands higher. Instead, what it most likely does, more often than not does, is that it first forms a range at the start of the candle based on a specific key time. And once it forms that range, It forms that range to generate liquidity. Once that liquidity is generated, it then has to form the low of the candle. And the low of the candle is represented by this manipulation profile here. Okay? What price does is, first of all, it forms a range. It does this so it generates liquidity for price to then take out. Once the liquidity is generated and then we enter a key time here like the London Open, price then takes out the liquidity at a key time, test a high time frame key level maybe here, and along with that it forms the low of the candle, the low of the daily candle, or you could say the low of the day. And once the low of the day is formed, that's when you start expecting a range expansion to occur to the upside. Okay, now the main idea here is that if you were to expect a range expansion straight away from here without it forming the low of the candle, and obviously you'd then be stuck at a range. If you had just taken a trade straight away here, then obviously you would have been stuck in this range, and then maybe it would have stopped you out here with this manipulation profile. But because you knew that price doesn't just expand straight away, but instead it first forms the low of the candle by forming a range and then having a manipulation profile and then expanding higher. Because of that awareness and because of that knowledge, you would have waited throughout this whole time period, throughout this whole price action. Instead, what you would have done is you would have waited for price to first form a manipulation profile, or maybe let's just say we have a key level here. So you would have waited for this manipulation profile to form or to occur, and with that manipulation profile, price would have then tested a key level, formed the low here. Maybe it also had an SMT divergence with a correlating asset, which is something we will discuss in the next slide. And then you would have waited for your entry and then taken an entry or executed your trade and then rode this range expansion higher for this high time frame candle. You can see right here that this is how you improve your anticipatory abilities and your anticipation skills, by using this concept, by using the intricacies and the details and the components and the elements of this concept right here. Now, again, just like I told you earlier, this isn't just the only version of it or the only variant of it. We've got many other versions that, depending upon the higher time frame market context, depending upon the position of key levels, dealing ranges, and so on. But this is basically the core idea here. Okay. Now, if you're worrying about the other versions and you're wondering when are we going to see them, then don't worry about that for now. Once I provide you with the trade breakdowns in the next few weeks, you will get to see the other versions playing out in real time and real market conditions, and you will understand them even better than how I explained this to you right here. Now let's move on to the next slide and let's discuss the next topic, which is SMT. Now SMT basically stands for smart money technique. In this context, we're talking about SMT divergences or price-based divergences. Now the idea here is this. Let's say we've got two correlated assets. Like for instance, let's say we have EU or GU, EU and GU, or maybe NQ or ES. Now normally these two correlated assets should be having the same sort of price action. They should be having similar price action. They should move in tandem. But sometimes they don't. Sometimes one of them makes a higher high and the other one makes a lower high. Or maybe one of the correlated asset makes a lower low, but the other one makes a higher low, which means there is a discrepancy and a difference in price action. And that discrepancy, that difference in price action is what we call an SMT. Okay, that difference represents a non-symmetry, which which is basically price saying to us that, hey, something's off here. Okay? And because of that SMT divergence, it could mean different things depending upon the context and its position. But what matters here is where that SMT happens. If it happens at a random place with no logic behind it, then obviously you ignore it. But if that SMT happens at a key level and there's logic behind it, that's where things get interesting. Now there's two core reasons why we use it. SMT has two core purposes. Number one is confirmation. SMT basically confirms your bias, right? It strengthens your conviction and adds clarity to your underlying or pre-existing bias. Okay? It adds an extra data point to your directional idea or your directional bias or your context. It is used for confirmation. The second thing is that SMT is used for validating liquidity purchase. Now, the way you use these two purposes in your analysis is by assessing or looking at the position of the SMT within a market context or within a dealing range relative to the higher time frame key levels and relative to the higher time frame directional bias or market structure. Based on those factors and elements, you can use SMT for these two purposes, confirmation and validating liquidity purchase. Now, just like I told you earlier in the previous slides, none of these concepts and none of these pillars that we've discussed so far are meant to be used in isolation. Okay, none of them will work if you use them alone to build an idea or to build a bias or to frame a trade idea or to develop a trade. The only time they work is when they are used in conjunction with each other and when they are properly integrated with each other in a step-by-step manner. That's the only time they work and the only way they bring meaningness and clarity to your trades and to your analysis. Okay? Now, moving on. Right here, we've got the two different types of price action based on symmetry or based on SMT. We've got symmetrical price action on the left and non-symmetrical on the right. Let's say we've got these two correlating asset or correlated assets. We've got asset A and asset B. Normally and usually what happens is that these two correlated assets form symmetrical price action and they move in tandem, which means that if asset A purchase liquidity below a low, then asset B also purchase liquidity above a corresponding high. That's what we call a symmetrical price action because they've done the same thing. But in case of an SMT, in case of non-symmetrical price action, what happens is that asset A purchase below a low takes out liquidity, but asset B does not. It doesn't take out liquidity, but instead it fails to purge above the high or it fails to take out, it fails in taking out this high. And this difference in price action, this discrepancy in price action, this leads to non-symmetrical price action. And this non-symmetry represents an SMT divergence. And because of this SMT divergence, if it happened at the right context, at the right position, relative to key levels and relative to market structure and dealing ranges, this could either confirm your bias, validate the liquidity purchase, or invalidate the liquidity purchase. The previous two purposes that we discussed, it could do either of these two things if it formed this sort of non-symmetrical price action, depending upon its context and depending upon its position relative to the other factors and elements. Okay, now this is just a simple idea of it, just a simple explanation of it. There are a lot more intricacies and details to it, which we will discuss in the trade breakdowns in the other chapters. So yeah, that wraps up the chapter. That was it for chapter 1. And basically, within this chapter, we've basically gone through all of the foundational stuff and the essential components that builds the entire access system, like from market structure to key levels to dealing ranges to SMT, all of that. Okay. Now I know some of you, not some of you, but most of you are thinking and saying that Sham, I already know this stuff. I've known this before. I've known this before for years. This is not new, and this is not why we joined the access circle. And yes, I know that. And to that, all I want to say is that I wanted to make sure that the first chapter of the access circle is an introduction to those core ideas and those foundational pillars. And the reason I wanted to do that is because I believe and I know and I understand that these basics and fundamentals matter just as much, if not more, as the frameworks, as the other structural frameworks and procedural frameworks that I'll be giving you in the next few chapters that I've prepared for you. Because the truth is that if you lack proper knowledge or proper understanding about even one of these foundational concepts or foundational pillars, then that could mess up with the rest of your performance or with the rest of your frameworks. And obviously, that's something that you don't want. And to avoid that problem for any, for even just a single student, I wanted to preserve the first lot or the first chapter for this introduction to the previous stuff or the past stuff that we've already allegedly discussed. Okay, that's why I wanted to revisit this stuff. Okay, now in the next few chapters, I'll be providing you with the knowledge regarding the actual application and integration of these core concepts. I will also be providing you the exact procedural frameworks or the structural frameworks that I personally use to perform my analysis or to build a directional bias or to define a market context on the 4 hour. I'll be giving you all of those frameworks as well.